Morning, everybody. Welcome to our Thursday workshop this week, alternating between Wednesday and Thursday, as you know. We're still in the August doldrums, I guess. Morning, everybody. Hi. Morning, Mike, Neil, Sadiq. Hi. Well, we discussed on Monday the events of this week, and I'm sure you won't be too surprised to see some of the moves that have happened, I guess. You're all aware of what caused the movements at 7 o'clock last night, one would assume. Anyone know what was going on? Any comments? I'm sure you all do. You're either... Yep, that's the one, Steve. Yeah, spot on. FOMC minutes. So we warned about the data coming out this week, and the key event really being the FOMC. For those of you who are who are new to this or a little bit unfamiliar with that description, the Federal Open Market Committee is similar to our MPC or Monetary Policy Committee here in the UK, which is the rate-setting committee for the Bank of England. The FOMC is the rate-setting committee for the Federal Reserve, the central bank in the United States. It actually has an additional mandate to that of the MPC, which is to manage employment as well. So that's one of the reasons why non-farm payroll is particularly important in the States, that weekly measure of employment or unemployment in the States, because it does affect what the Federal Reserve or the FOMC deliberates on. Okay. Quick review of what actually happened earlier on in the week. We mentioned a few things that were coming out. Public sector net borrowing. This is basically what the government borrows or repays, as should have been the case. Obviously, we're here in the UK, we're engaged in quite significant and severe austerity measures to improve the public finances, basically repaying all the money that the Labour government have borrowed in the last two terms. Some would argue that it's too severe, that it's preventing growth, and to a certain extent, you might read into these numbers just that. The fact that, just have a look at the data here, Treasury, which is the department of government that looks after the finances, they expected to pay off 2.2 billion. I'm not altogether sure what the public sector net borrowing here was calling for, because we were looking for a repayment, i.e. a plus figure of 2.2 billion, which is normally down to good corporation tax receipts, self-assessment tax receipts, etc. But the Office of National Statistics painted a different picture and revealed that the government actually borrowed 600 million. And this is quite significant. So it was expected to repay 2.2 billion and instead borrowed 600 million in what is normally a very good month. This didn't help sterling or the gilt market, if anyone trades the long gilt market. And it looks like the government now has borrowed 11.6 billion more in the first 4 months of the year than in 2011. And that excludes these sort of one-off items. They've got this 28 billion Royal Mail pension transfer and this special liquidity scheme for Britain's British banks. But not a good picture there. Other than that, the data came out on home sales yesterday. Little bit weaker than expected, but in the context of what's going on, as I said to you about a month ago, the paradox with what's happening now, with markets now are reacting to expectations of central bank intervention, central bank monetary policy easing. Quite how they can ease it, God only knows, or how effective it will be. But the markets have reacted very positively. If you remember, Draghi, who is the ECB president, he was over in London before the Olympics on that Thursday when he said that, they will do what it takes to preserve the euro, and believe you me, it will be enough. And ever since those words, that's been ringing around the markets. And It is thin. It is August, so not reading too much into this, but there hasn't been any bad news. Yields on Spanish and Italian bonds have come off very sharply. They're below June levels now, so you're talking about 10-year yield on Spanish bonds around 6.2 compared to the sort of 7.7 peak in early July. So it's a significant recovery there. And as I said to you on Monday, a lot of what's happening really in this month is down to a lack of bad news rather than any good news. And you've just got to remember that a lot of money managers are underweight equities, and there's a lot of cash sloshing around the system. So there you go. That's one of the reasons as to what is happening there. Which takes me on to our topic that Steve mentioned, the FOMC minutes. This came out last night at 7 o'clock, and I'm sure you are all aware what happened at 7 o'clock. If we look at any markets, let's look at my correlation. I've got a few markets here. Gold, the euro, copper, E-mini, that's the S&P. Treasuries at the bottom there and the FTSE. If we look at, say, an hourly chart on all these markets, okay, you can see here, top right, gold obviously reacted. Why has gold reacted so positively? Does anyone have an idea? Any ideas? Gold? Why is gold so strong? Safety. Risk aversion. Yeah, bit of safety, bit of risk aversion. I think it's the liquidity, really. Yep, Cliff, you've hit it. QE possibility, Neil, you're right. Yep. Roger, yeah, breaking 1640, that's a sort of technical move, you're right. That spurred more buying. But I do think it's this QE, and it worries me that is the drug that we can't wean ourselves off. And the big irony is that, when QE works, and they take their foot off it, the markets just then reverse. And I think that is a problem that the markets have got. And this drug of QE is becoming less effective. But certainly, this top left chart, gold spiked, 7 o'clock. That's a 7 o'clock bar. Well, that finishes at 8 o'clock. That's basically what caused that move. Middle, top, dollar, euro dollar, yep. On E-mini, we saw the equities turn around, so the Standard & Poor's 500, that bounced significantly, and yields as well. Yields on treasuries improved. Why would yields improve? Why would yields go down or treasuries go up whilst gold's going up and equities are going up? Again, in answer to your question, or my question, which was, why would gold go up? It is QE, more money around, basically. More money, cheap money, borrow money, and support some of these commodity markets. So I'm pretty skeptical about it, but in the short term, obviously, we know where the trends are. If I go back to our daily charts here, it is very clear to anyone looking at these markets, we are in, we're breaking the top of the envelope in gold. Obviously, Adrian's addressed the sort of the longer term sort of targets on gold. Euro dollar, look at this. We're certainly pushing the highs from beginning of July. So that's a significant move, and it almost, it looks like we're going to be targeting this sort of 126.80, 127 zone. So, trend's your friend. That's where the long term trend is. Whereas the FTSE, different sort of market, really. You might be wondering why other equity markets and markets in general have responded quite positively. Well, of course, we've got our own unique set of problems here in the UK with this, especially with the poor state of the public finances gaining a little bit of attention again, so that may be a bit of a problem. I'm not convinced the FTSE is going to be topping out, of course. I think we're going to have to wait till early September to have a clearer picture on that. So, back to our numbers, back to the data, back to the FOMC. The FOMC minutes that caused this, basically, they stated that they're going to ease policy unless there's a sharp change in economic data. The minutes of the August meeting revealed a very strong consensus for action. many members judge the additional monetary accommodation would likely be warranted fairly soon, unless incoming information pointed to a substantial sustained strengthening in the pace of the economy. I think it's highly unlikely that is going to happen. This statement actually is unusual and makes it very, very clear. Charles has just asked, what do you think will happen when QE actually happens? Do you know, Charles, what Charles is asking is, we all know that they're going to do QE. The markets want this drug, QE. Draghi has said they are going to do something to support peripheral bond yields. The Bank of England has said they'll do some QE, possibly. They will support longer-term interest rates, i.e. keep a lid on longer-term interest rates. This is all in the market. When it actually happens, Charles, I've got a feeling it will disappoint the markets. I really do. And we've had this cycle over the last 18 months, Charles. My own view is that this is a buy on rumour, probably sell on a fact. I think the market's expectations are ahead of what actually could end up happening. Certainly the FOMC, they have noted that their second round of QE was less effective than the first, and yet they're now talking about a third round of QE. They discussed a range of tools with which to ease monetary policies. They can do other things, but really the most effective is a third round of quantitative easing, and under that sort of QE quantitative easing regime, they buy long-term assets, thus lowering bond yields for not just sovereign debt, but also for corporate debt as well. So it makes it cheaper for companies to plan investments, etc., because they can price their borrowings, their longer-term borrowings, at a lower cost, which is obviously positive. What they're trying to do is to stimulate investment and stimulate growth. They also discussed the possibility of actually doing this open-ended program, which is not QE of 400 billion or 500 billion, just QE. We'll just do it until we feel that it's done its task. And they're saying some participants of the Federal Reserve's rate-setting committee, they thought that a new program should be sufficiently flexible to allow for adjustment. So what they're saying is, well, let's start the deal going, and then, if we want to add to it, maybe we'll add to it. Steve, why is junk debt called an asset? Yeah, well, what you're referring to is junk debt is as rated by the rating agency as junk. Well, it is an asset. It may not be a particularly good asset. That's the only point I would make, Steve. If we've, companies and governments have issued securities, the fact of the matter is they don't set out to issue junk debt, although some companies do, very low-ranked debt. But junk-rated sovereign debt of the likes of Greece, Ireland, etc. It's quite tough for those countries to even consider tapping the capital markets again for their own purposes. But Charles, why, if they all do it, would the effect on currencies be neutral? So what Charles is saying is, because what happens with quantitative easing? Well, effectively printing money. And just a simple rule in terms of the laws of supply and demand, if you have constant demand for something and you increase the supply, the price goes down. Charles is suggesting that if all the economies, the major economies like the Eurozone and the US are engaging in QE, will the effect be neutral? Do you know, I'm not surprised to see what's happening, though, Charles. If you think what's going on in sort of the fundamentals picture, you've got no further bad news. Most of the bad news is in the market, the euro. This is a sort of a slight confirmation that the US economy isn't doing as well as expected. The big irony is it's doing so much better than the Eurozone bloc as a whole. But they are concerned, especially with what's happening towards the end of the year, something called this fiscal cliff, where there's a possibility that the US might enter a double-dip recession, and this is was put out by something called the Congressional Budget Office that warned of a double-dip recession unless Congress tackles this fiscal cliff. The fiscal cliff is these mandated spending cuts and the expiring of these tax provisions at the end of 2013. The feeling is that it would warrant a lot of stimulus to offset a lot of those effects that would come into play at the end of this year, start of next year. So in what I expect, my belief is that you could see the euro squeezed further, but I think the chickens will come home to roost again. Other data that has come out just recently, we've heard quite a bit about the Eurozone issue to do with Greece. I don't think it's a big deal, this Greece, not so much anymore. If we go to... where do we go for this? If we go to Europe, maybe. Okay, so here we go. Eurozone leaders delay Greece aid decision. It's interesting, this. You know, nothing is going to happen before September, and in fact, they're saying nothing until possibly October time. And this is this key question as to whether the EU, that's the EU Commission, the International Monetary Fund, or the IMF, and the European Central Bank are prepared to offer Greece more money, because Greece is saying that it borrowed 174 billion and it had to put in all these sort of quite strict austerity measures, etc. And because it's done that, its economy has slowed down a lot faster than expected, and as a result, it's got to borrow 20 billion euros even more. I don't think Greece is quite the problem really anymore. I think it's more the systemic risk that they've managed to sort of neutralise for the time being, i.e. the risk that once Greece goes, that spreads to Spain, most importantly, which is a very big economy compared to Greece and Italy, as witnessed in the spike in both Italian and Spanish yields in July. And I think that is the Greece issue is interesting, but I think it's more. I think that sort of is dealt with in a way, and I think the risk of Greece blowing up is less. And I think there's just going to be a bit of hard bargaining, but they're very keen to protect and insulate the Spanish and Italian economies as much as possible from any fallout there, which is the main focus. Other than that, what other news have we had? Let's go back to our little calendar. That's pretty much it, really. Well, we've had data coming out this morning. Let me just refresh this calendar here, because we've had some flash manufacturing in both France and Germany. Yeah, better than expected. Remember, those numbers were pretty appalling last month. I think they were a bit overcooked. So we have had improvements from both those numbers. So the flash manufacturing number, still lower than 50, 46.2, but better than expected. And with the German flash manufacturing, so this flash, it's effectively a preliminary piece of data, 45.1, still contracting, but not contracting as much as in the previous month. And we will then get a final reading on the euro-wide area in a few minutes and quarter of an hour, in fact. Other than that, I think we also mentioned data in China, if you remember. This is the flash manufacturing in China. CNY is the symbol for the Chinese currency. That's what it focuses on. HSBC, independent from the Chinese government. The market listens to non-governmental agencies or institutions that publish data, because they carry a lot more veracity, for want of a better description. The fact is, weak Chinese manufacturing data. That's pretty much it. So it's raised calls from Beijing to add stimulus efforts with a poor reading on shipments, suggesting little improvement in global demand. This Chinese Manufacturing Purchasing Managers Index for August, it fell to a 9-month low of 47.8, I think it was. Now, they don't put out what was expected, HSBC, but it's on a 100-point scale, and below 50 is contraction, and it's dropped from July's 49.3. So it really is a pretty poor run, and it's at a 9-month low, and it's basically down to weakness in new orders and shipments, it really is a contracting sort of sector, and there is concerns that this is going to lead to a hard landing in China. So that's something that we don't need, or the global economy doesn't need. So anyway, in summing up, data remains pretty poor. Expectations for central bank intervention remain high. The euro and equities remain positive for the time being, whilst there is no bad data. We're in August, the August doldrums. I don't expect activity and volumes to pick up until after Labor Day. Labor Day is the first Monday in September. Once that's out the way, everyone's back at their desks, politicians, and most importantly, the key hedge funds, investors, traders, etc. in the market. As liquidity picks up, we will get a lot clearer picture. But for now, the trend is your friend. Keep watching and using the same analysis. We don't care whether it is liquid or not. The fact of the matter is the trends are there, the trends are to be traded, and there's money to be made. Data, remember, for later on today, we got new home sales. That's key at 3 o'clock. So keep your eyes focused on that. And also the regular weekly unemployment data. We're still expecting data around the sort of 360 to 370,000 range on a weekly basis. Revised GDP data in the UK on Friday, so that will have a bearing on sterling and gilts and the FTSE. And then later on, this very important bit of data, core durable goods on Friday at 1:30, which is as I said to you on Monday, one of the most important economic releases in the calendar month in the US. Thanks very much for listening. I hope it's been useful. Any other questions, please send us in your emails. Actually, Charles has just said China will drag Australia down. Do you know, I think absolutely that. I'm amazed actually how strong the Aussie dollar has been. That's trended really well. The fact of the matter is, a lot of the sort of commodity-based currencies, the Aussie, the Canada, they've all had reacted quite negatively to a slowdown in China. But really, Australia depends so much on China. Basically, what they've been doing over the last 5, 6, 7 years, as you've seen a dramatic rise in a lot of mining stocks, etc., with the regular pullbacks that you'd expect when we hit the credit crunch and liquidity crunch in 08, 9, and 10. But they're effectively carving up Australia and shipping it out to China. China has got so much unsold stock, half-completed buildings, etc. It needs to maintain a serious growth trajectory to stop it from crashing. And the likelihood is that the longer this sort of slowdown lasts, that it will accelerate. So it is a worry. And Charles, I think I think the charts will tell us what's going on when that is happening. But it's full of cash. Australia full of cash. No, you're right. Roger's saying it's full of cash. Yeah, it's got a strong currency. That's not helping it export anywhere else, of course, Roger. It's benefited from the Chinese growth phenomenon, and it will also suffer as that condition in China continues. So, but the question was, will it bring Australia down? It certainly will have an effect on Australia. Roger said it's only got sheep and poms. Actually, to be fair, 20 million people, whatever the population is, Australia, it does pretty well for its size. I mean, I've been on business there a couple of times. You do feel like you're on the moon, so far away from everywhere. But nice weather, nice people, and whatever. Jonathan, unemployment rising in Australia and finding work is getting harder. Many friends there. Yeah, Jonathan, I'm sure that is the case. Actually, they have been cutting rates. I think they're on hold at the moment, the Royal Bank of Australia. But, hey, they benefited. They should be travelling like you wouldn't believe. They should be taking their Aussie dollars and buying property and, God knows, cashing in, because if China does have a hard landing, it ain't going to be pretty in Australia. Anyway, listen, thanks very much for listening. I've enjoyed talking to you this morning. Good luck with the markets.